It is September the 11th. I'm delighted today to be joined by Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters, Jamal Qureshi, MD, Analysis and Strategy at Petro Logistics, and hopefully soon to be joined by Maliha Bangali, founder of MB Commodity Corner. Clyde and Jamal, thanks for joining us this morning. We have one of the survey questions we put up this week. Obviously, war games again active here in the region where I sit, in the Gulf, and there's a survey question: 63% think that the attack on Qatar yesterday, or the day before, I should say, by Israel is a game changer for Middle East geopolitics. Jamal, let me go to you. Is it a game changer for the oil industry at all? We haven't seen much reaction from the oil price so far.
For the oil industry, insofar obviously as geopolitics it is, but at the same time, from a geopolitical perspective, I would suspect that this is about as far as actual potential for physical impact on oil markets can go, or that we've seen that in terms of, for example, the war with Iran, these, and then strikes on other places that aren't necessarily oil impacted in the region. So I think this shifts the dynamic to a position where regional players increasingly don't want it going further than it is. And there'll be more of a willingness to say, we're willing to put up some barriers to try to prevent sort of Israeli power from stretching much further than this to places that can affect our own interests in a way that I don't think has been the case before.
I mean, like, for example, like what? I mean, what could be more direct than starting to bomb Gulf countries at will?
Yeah,
and not, and of course, not oil facilities. But clearly that wouldn't be done probably. That would be shooting itself in the foot from Israel's point of view, and from an American support point of view. But surely the sense of, U.S. security in the Gulf has gone to zero if this can happen, and that does impact relationships between Saudi and America in terms of compromise on what they're doing with oil and supply, etc.
I mean, this is part of a breakdown of trust in American power. And so I'm kind of threading a needle here and saying that obviously, yes, can things get worse? And could this be something that could, impact physical infrastructure at some point? Yes. However, I also think this is something of a wake-up call. Not something. I mean, obviously, it's a wake-up call to the point where it can restructure political alignments to a point where I think Gulf governments are going to say, you know what, we need to see that this is a larger emerging picture here as far as reliance on the protective umbrella of Washington, and as far as sort of a certain trust in the Israeli government to have limits. And I think that starts to break down here, and that works in a way where more of a defensive reaction, by which I mean a willingness to defend their interests more powerfully kicks in, and that does something to mitigate risk to oil markets, I think, even though it'll stay highly volatile.
Yeah, great. Okay, well, Clyde, let me go to you, and let's talk a bit more about fundamentals now. I mean, and what those are telling us about the oil markets and oil price as we sort of approach the fourth quarter. Clyde, China has been attributed very much for sort of helping to support the sort of supply excess in the market, taking up a lot of that into storage. A lot of talk out of APEC this week in Singapore that is expected, that support is expected to continue into the fourth quarter. Would you agree with that? And can it continue into next year, given the supply that we're seeing come out of OPEC and non-OPEC countries?
A lot to unpack in that. Yes, I've been at APEC as well this week. I'm still actually in Singapore, and it's been fascinating to see that for the first time in a long time, people are actually really talking about China's storage as a major driver in the market. I mean, I've been banging this drum for years, but suddenly the message seems to be getting through a little bit. Short answer is, can it continue? Yes, even though best estimates sort of put China storage at 1.2 to 1.4 trillion billion barrels, which is well above the 90 days of import cover. But, they still have storage available to them. But I think to me, there's a growing sense, mainly amongst the Chinese buyers themselves, that they're starting, while they've been happy to store at that sort of mid-60s level this year, they're starting to think, well, if we want to store more, we think oil should be more in a 50 to 60 range rather than in a 60 to 70 range. So in order to sort of, if they want to test that theory out in the market, the best way for them to do so is to stop storing for a few months. So, it wouldn't surprise me if I am correct in thinking that the Chinese are thinking little too high, given the world economy, supply demand fundamentals, that sort of thing. They might think, well, instead of importing closer to 11.5, 12 million barrels a day, we're going to trim that back to 10 to 10.5 million barrels and see if that can push oil prices down into the 50s. I mean, this also presupposes that OPEC actually does bring back, or OPEC Plus brings back the oil they say they're going to bring back, which quite frankly is a bit of a question mark as far as I can see. But I do get the impression that the Chinese are probably getting to that point again where they're willing to use their storage flows as a price control mechanism. But what they're going to be trying to do is push that price down below 60.
Interesting. Well, Maliha, let me go to you with that, because, of course, another thing that came out of APEC early in the week was, a few commentators and analysts there saying oil still has a way to go down before it sort of goes up again. Of course, we've seen it weaken this year, but some people calling for another $10 down. But a lot of others saying it has to start catching up with everything else, or other commodities and equity, froth, etc. And with a Fed rate cut expected, where do you see us sort of oil possibly going in range bound in the fourth quarter, subject to macro policy?
Thank you. You're absolutely right. I think the market right now is focusing a lot on macro. We know of the demand side. I mean, Clyde explained it very well in terms of demand, supply, and balances. The bigger picture here is interest rate policy and Fed liquidity. Now, we've seen the negative job revisions. We can argue about the legitimacy of those revisions, and the PPI numbers came in weaker. The Fed basically has a dual mandate, and right now they've got the ammunition to cut rates. We don't think they should, because the economy is actually not as soft as they think it is. But we have a Fed that's getting politically coerced to cut rates and also to get the funding rates down. They may be sort of, egging the market further on. If that happens, we're going to get more liquidity, which means asset prices will go up. That's why equities are rallying. That's why bonds are rallying. We may not agree with it, but having said that, commodities will actually have a bit of a bifurcation, right? You have gold doing well, silver doing well, but oil actually will be capped by its demand supply issues, but the tailwind will come from the liquidity. So oil can be range bound. We think that there's not enough juice to actually buy the oil market, but we can see it moving high because of liquidity. But then again, the supply issue, the demand issues will actually cap the oil price. So yes, that's the unfortunate fate with the oil market, but the macro is very important. And despite us arguing about what the Fed's doing, liquidity will carry all relevant asset classes, especially markets that are tight.
Okay, Maliha, thanks. Jamal, let's talk a bit about fundamentals again, sort of oil on the water, and let's talk a bit about Russian oil as well. Going into Asia, going to India in particular, we've had that sort of tariff back and forth between the US and India, and US obviously holding that sort of threat on India of stop taking Russian oil, or you're going to get tariffed more, if you like. Is that just empty talk, do you think? India's obviously defiantly said, we're going to continue to do what we want in our own economic interest. Where do you see that going in the next couple of months?
Yeah, no, I think we're going to continue to see, because of that breakdown of trust in Washington, because of the breakdown of trust in Washington as a rational actor, that even trust in the idea that you can sort of stroke Trump's ego to get what you want, all of that trust is broken down. And so because of that, you marry that with the natural sort of nationalistic response you get out of a place like India, and then a sense from the Chinese that they're going to have an opportunity to step in, to be the mature player on the block increasingly. I mean, these are not new trends, but I think they're being sped up. And then alongside that, the ability to forge new alliances, I think, is taking on more realism on the global stage. So some of the obviously the arms displays in Beijing and the folks that invited to the play, and then everything that's happening in Gaza and sort of the geopolitical alignments that are shifting there. all of that says that the oil will continue to find its customers.
Clyde, I mean, talking about sort of geopolitical alliances and trade, of course, China, playing a big part in that from a trade point of view, from a manufacturing export point of view to the US. What is the economic sentiment, do you think, in Asia, China and other, South Asian and Southeast Asian economies now? Has the tariff threat, is people getting used to it and sort of settling down and thinking that it will be resolved with the US, or is it actually showing some economic impact and nervousness on the ground?
A short and a longer term answer to that. I think people are getting more confident that we're reaching the end of the tariff tunnel, notwithstanding that the US Supreme Court may set certain parts aside. That's not my base expectation, but it's a risk. At the end of the day, we still don't have a sort of set in stone deal with the Chinese, but we're kind of getting to the point where we think that might be getting closer. India is a bit of a worry, but the rest of Asia is sort of just adapting to the new reality. What it does mean is that what they've seen is that Donald Trump is a very transactional kind of guy, and that long-term relationships with the US are not really possible. So a lot of the feeling in Asia is, well, if he's a transactional guy, we're a transactional guy too. So we'll just transact with the US on the basis of short-term deals, no long-term expectations. And in the meantime, we'll start to build trade relationships that do not focus on the US. So I've always said that the ultimate consequence of America first is America alone, and then probably over time America last, because people just really don't want to deal with them. In my home country of Australia, America was viewed as our biggest ally. The latest public opinion polls show that Australian trust of America has plummeted into negative values. We'll do business with you. We'll sell you our beef, but we're not really wanting to trust you or have a long-term relationship with you. Those things have changed. And I think you can already see that as how trade flows are being structured. The next thing to get restructured will be security arrangements and things like that. But, certainly the idea that America was the backstop of Western democracy and that kind of thing could be relied upon, that's gone. And I don't see it coming back.
Yeah, that reliance is certainly wants to be lessened. I mean, the military threat really is what America holds, isn't it? The military strength, I should say. Otherwise, you probably would see countries back away from those relationships even quicker, because economically, that certainly there's new avenues for countries like China and others in the global South to take. Maliha, I mean, just going back to the US economy. We got the jobs report at the beginning of the week, and then it was, I think I saw one or two figures adjusted even more negatively, let's say, and an article saying, have we already hit recession in the US? Are we going to finally see, I mean, we've been talking about recession's going to hit the US for years now, and putting equity markets aside and liquidity, but on the ground, jobs, inflation, cost of living, would you put your money on that we will see more negative figures materialize in the fourth quarter?
You're absolutely right. The US economy is slowing down. Only pockets of strength are seen in AI, cloud computing, and all those sort of things right now. If you look at consumer sentiment, the average cost of living, is quite at lows right now. And also the question is, we're seeing a lot of jobs being replaced by AI, and that trend's going to go on right now. But the Fed cutting rates or, boosting the job market, it's not going to happen. It's not going to help the market because we're going through a paradigm shift. So you are right. We are seeing a slowing down. The economy is holding up pretty well. I think the mistake is that people are looking at the change in payrolls. Given the mass deportations, the advanced birth decline rates, also in terms of less immigration, population growth, we don't have the same break-even payroll growth need as before. I think there's a very good comment by Jim Bianco made on Bloomberg a little while ago that the Fed's looking at the average rate of 100,000 payroll growth numbers. Maybe the more break-even rate is closer to 20,000. So we're not as weak as the economy thinks. The unemployment's at 4.2%. So why cut right now when inflation's at 3.2%? So you are right, the economy is slowing, but the way they're fixing it is really not going to help. And I think the US will go into recession next year because this year there's way too much liquidity being added to the markets for right or wrong reasons. But yes, there's a lot of issues into the market into next year. Tariff concerns, the PPI, companies have not passed through costs yet to the customers. They're all holding back. I think eventually we'll go see much more of a slowdown. So we're in the stagflation camp. That's our view.
Yeah, I mean, companies have been holding back, thinking everything will be resolved on the tariff front, but those costs will start obviously being passed on to consumers. Jamal, let's talk a bit with you about OPEC volumes, OPEC plus volumes. Clyde mentioned that, they may have pledged to add a bit more from October, but actual additions anyway have been in question. The ability of certain members not to even add oil, etc. Internal sort of dynamics there. Is the market paying attention to OPEC plus volumes anymore, or have the other factors that we've been discussing today taken precedence, given that also they can be very flexible? But how critical is that, do you think?
I mean, I think the market's definitely watching, but they're doubtful of the volumes that can be brought on. I think an interesting thing here is, we get a lot of questions about capacity, and there's real questions around that within OPEC Plus as a whole. If you compare volumes now to where they were pre-COVID, in theory, there's more than 4 million barrels upside, and that's not even getting into the capacity. That's just to where previous peaks were at. So in theory, there could be volumes there, but of course, it's very concentrated. Obviously, the Saudis and Russia, although there's question marks over how much there is there. So what OPEC Plus has done here really is set up optionality. Okay, they removed a lot of the voluntary cuts. If they want to slam it back down now, they've got room to do that. If they want to keep pushing things up for whatever reasons, whatever they want to test the market with, they've got the ability to do that. So the question becomes, yes, the market
share. I mean, is the market share factor featuring really in their thinking? Is it just coincidental that they're keeping adding volumes, or is the market share aspect, do you think, in their medium-term thinking getting more serious, given what's happened to oil prices?
I don't think it's a critical issue, but again, I think they've set up the optionality where if they feel like it's a problem, if the price starts coming down, if core Gulf OPEC decides, you know what, we want to be able to sort of test and cajole people into better compliance, they've got the tools to do that. If, on the other hand, the market can absorb the barrels, that's fine. They'll take that.
Okay, Clyde, I mean, back to the health of Asia. What are other commodities telling us in terms of metals and minerals and PMI sort of predictions on that front from, let's say, the non-China economies in the region? Are we getting support there medium term for the oil markets, do you think, as well, in terms of the likes of Indonesia, Vietnam? How's the picture looking as we come to the end of the year?
It's one of those sort of pictures of things are okay without being great. The growth, economic growth, Asia, I mean, some parts of Asia have done pretty well. India is still holding up quite well. But if you look at the ASEAN nations, you would say it's steady, not spectacular. They're sort of holding their own. Their import volumes of commodities, and for those that export, like Indonesia, they've been okay. It's not just... If you look at the developed parts of North Asia, so Japan, Korea, Taiwan, they've been steady again without being terribly flash. So you get the overall picture you're getting, even when you add China back in, is that sort of. I hate to use the word like poddling along, but that's exactly what it is. I mean, it makes it actually quite difficult for me to write comprehensive things about the state of commodity demand. Some have actually held up quite well. Iron ore has actually been the big surprise for me, because everybody said, oh, the Chinese industry, steel industry and construction's way down, but iron ore imports are actually up quite well. Coal is flat as a pancake, not so good. LNG is down. That's mainly the Chinese. LNG prices are still too expensive for Asian demand to rise. That's largely because Europe is still buying quite a few, quite increased volumes, even though it's been tapering in recent months, but they're still buying much more than they used to. So, the overall picture you get is fine, but not great.
Maliha, let's talk a bit about, again, sort of other assets, if you like. Gold has been, again, I mean, gold, US dollar, I want to see what your outlook is for that. The US dollar has been weakening to an extent, but perhaps in some people's opinion, not as quickly as it was expected to. And of course, it will weaken further once we see rate cuts, and that impacts obviously gold buying as well. But those two sort of instruments, if you like, where do you see their trajectory as we go into the fourth quarter?
I think the way the gold price is moving is signaling a lot of distress in the markets. We have a fiscal issue, a fiscal deficit issue across the board. I think the gold market knows that the US economy and also global economies right now have no way to cut their debt. In fact, they're going to be issuing more money, raising more debt, and given the fiat currency debasement story. So, look at global bond yields in Japan, UK, France. We're seeing massive yields on the back end. The bond market is saying that the back end yields are higher because the Fed's going to be making a mistake and the front end yields are falling. That's called a bear steepening. That's not a very bullish market. So the gold price is actually preempting that. So you have a lot of, despite what the dollar does, I think there's a secular demand for gold right now because it's the only true safe haven investment in a world that's stagflationary or recessionary. And on back of that, take a look at the demand for gold from central banks outside developed markets. They're all diversifying, selling treasuries to buy gold. So you have massive demand. China's been adding. Russia. So you have this amazing bull market for gold on a macro and micro level. And usually when bond yields go up, gold should be falling, but there's a massive bull run in gold. And you can talk about whether Bitcoin should move that way, but people are not trusting governments and the debt is a huge issue. And now we're cutting more rates. So we sort of see gold going higher because it's truly the best asset to own. It's up 40% this year. It's up 10% in the last 7 days. And that's important. The dollar, you can argue that near term, it's probably pricing too much negativity. But then again, Trump's entire plan is to have the dollar price lower. But near term, if we get a slightly hawkish rhetoric from the Fed and people are very sure the dollar could squeeze higher. But these are just short-term trading games, right? But the bigger picture is one of heightened deficits, more fiscal expansion, and more debt and inflation.
Okay, thanks, Maliha. There's our survey question for today. Trump's words on putting a big squeeze on Russian oil revenue ring hollow. Do you agree or disagree? Certainly, he's being criticized for doing nothing about squeezing Russia in any way from extra pressure in terms of the Ukraine war. If anything, the opposite. Of course, Jamal, we've seen some heightened tensions in Europe in the last couple of days with that Russian drone being shot down. I won't get into too much into the geopolitics of it, but you're based in Norway, and what is the mood in Europe at the moment from sort of a political but sort of economic point of view in terms of how the sentiment, the central bank policy, etc., and is that impacting oil to any extent in terms of even how it trickles through to products, etc.?
I think the direct oil impact is fairly limited. Obviously, folks are on edge a lot, and the consolidation of sort of a belief in the need for sort of European cooperation and consolidation is growing, especially amongst
growing.
Yeah, exactly. But also the organization slowly and sort of EU bureaucrats pace. But those things are moving. But in terms of the actual impact on oil, at this point, it's still fairly limited. Ways are being found to limit things. You have some pipeline shifts that may allow, for example, more Kazakh crude to move in to replace some of the slightly remaining Russian pipeline crude, for example. So there's little things like that happening at the margin. But as far as the ability...
Okay, sorry to interrupt you. What about the dark fleet sort of logistics, if you like, as sanctions continue to prove ineffective, whether it's Russian oil or Iranian oil? Again, no sort of impact being seen there, no change, if you like, on that this year. If anything, that dark fleet is growing.
Yeah, that's correct. That's correct. I mean, look, we've seen the limitations of what these sanctions can do. We've seen the ability to work around them. And if you look at sort of the three main sanctioned countries around the world, right? You look at Iran, Venezuela, Russia, you see this pattern. Tighter sanctions come on, create some short-term dislocation, question marks, issues in the market. And within 2 to 3 months, they found a way around it again. And that pattern should continue to hold up.
Okay, Clyde, I mean, we mentioned Japan briefly, I think, earlier in the conversation, but let's talk a bit about that as well. Again, some political turmoil there in the last week as well. And of course, all the fun and games with its interest rates and its monetary policy sort of changing this year. But again, what impact do you see on the economy there? And again, any sort of signals that gas markets even should be looking to be coming out of Japan, and does it matter in terms of LNG imports, etc.?
Political crisis in Japan is quite different to political crises elsewhere in the world. They're very polite and seem to be quite well organized, and quite frankly, nothing really had a sort of change in monetary policy and what's been going on with their own inflation and things like that. They've obviously been much more worried about the US tariffs than many other countries, given the high level of exposure of some of their key industries like autos to the US. Has that actually altered their behavior that much? We are starting to see quite a bit more US LNG flowing into Asia, particularly into Japan, because the Chinese aren't buying any at the moment. And I imagine the Indians will stop forthwith, given their current disputes with Donald Trump. But you are seeing more US LNG going to Japan and Korea in particular. Not seeing too much more in the way of crude oil going into those countries. There has been some uplift in US shipments to Asia, but again, what they might be gaining on countries they've done deals with, they're losing on countries they're not doing deals with, like China and India. So it's quite an interesting sort of dynamic at the moment on the whole idea that US LNG and US oil was going to start playing a much bigger role in Asia. That's not actually happening because they're effectively shut out of two of the biggest buyers of those commodities. And, that's going to have an impact on them.
Okay, Maliha, US oil, I mean, how is that doing this year from a price point of view? Obviously, it's still relatively well supported at these oil prices for production purposes, but some people and many saying even at $55, US oil would continue to remain at current levels. But what is the sentiment, would you say, coming out of that industry at the moment?
You're absolutely right. I think right now the US companies are making money. I think the fact that Saudi is trying to gain market share to sort of eliminate some of the high cost producers, I don't think that will happen until it gets to 55 or in the high 50s right now. US companies are a bit more cautious on increasing capex. I mean, shale production is holding up, but yes, investments is pretty much in status quo mode. There's no incentive to sort of increase, but in prices fall below 55, we think that'd be a bit of an issue. But right now that remains to be seen because there's still a lot of expected hope for demand recovery, but there is that issue, correct?
Okay, Maliha, just sticking with you, I wanted to get your take also on European monetary sentiment. I mean, you're based in the UK. Again, from a central bank policy point of view, they haven't necessarily been moving completely in line with what the US has been doing in the last year or two, I mean, more or less, but will we see divergence at all, given the state of both sort of regions economically?
We've seen a bit of a divergence, but I think the ECB latest commentary has been that they're probably not going to be cutting rates anymore. The UK BOE said the same thing as well. They've always sort of kept rates down. The question now is, what does the US do? And I think there's a bit of a time lag effect. These banks generally tend to follow the dynamics of the US because they're sort of faced with the same sort of macro backdrop, heightened sticky inflation, slowing growth, high fiscal deficits. But right now, we think the ECB and the Bank of England are probably done cutting rates. And it's probably the Fed that's going to be looking to cut rates, probably a little bit near term. And then on back of that, they're going to follow them. But for right now, there is that sort of, breakdown between the two of them, but they all have the same issue. So when we talk about the dollar markets or the euro, the sterling, we're playing this very sort of short-term game because the big three markets are faced by the same macro dynamics as we see, really. The game is more versus emerging market currencies or other sort of dynamics. I think that'll be, or the yen, that's going to be a lot more prevalent than trading the euro, the sterling.
Okay, Jamal, let's end our half an hour with you. I want to talk a bit about what you might have to add for us on Iranian oil and oil exports. There's our survey result for everyone to see, agree. That's not a surprise. From what we hear or see, again, talking about the back to the dark fleet, but not much change in exports this year. Have you, and to come? I mean, it's gone a bit quiet geopolitically on the Iranian front anyway in the last quarter. But again, from what you see on the water or from intake numbers, should we expect exports to continue as they have been?
Yeah, I think more or less. This cycle I talk about of taking a few months to work through each new round of sanctions or a war in this case, which they weathered quite smoothly, all things considered. What we've seen is that, yes, for example, floating storage of Iranian barrels in Southeast Asia built up.
China stopped for a while.
Yeah, and that's not an unusual response. It has held at higher levels longer than past cycles. But that said, it's flowing through to the final consumption in China. Mm-hmm. So what we can say is sort of, in a sense, the pipeline has gotten fatter and fuller, but it's continuing to flow. And I think we continue to see that. Maybe the one interesting thing is that we had, for the course of a few years, seen a steady rise in those Iranian exports, and that has leveled out at the current levels. So we may see a case where the growth doesn't resume, but they can continue to maintain these levels more or less.
Yeah, and as you said, a lot being maybe held in storage. I mean, China seems to be a very big determinant on that front, both for Iran and obviously for supply absorption in general. Thanks so much, Jamal and Clyde and Maliha, for joining us this morning, everybody and everyone else for joining us, and have a great remainder of the week.
Thank you
All
so
the
much.
best.
Thank you. You too.
Thank you.